Welcome, dear traders. You are watching a recap of the Asian session on August 13. Assessing the US statistics, markets remembered that every cloud has a silver lining. As a result, Japan and Australia's indexes followed Wall Street and showed growth on Wednesday. Equity markets were boosted by weaker employment data, falling house prices and consumer sentiment in the United States. All of these factors are setting the stage for the US regulator to take a pause at the next meeting of the Fed. However, many investors were leaning towards a more hawkish Fed after Jerome Powell's speech. The Fed chief said in a Jackson Hole that further policy tightening may be needed to cool down inflation. At the same time, Powell promised to proceed with caution, noting that the central bank's future moves would depend on incoming data. Indeed, his speech encouraged both hawks and doves, and today the latter still prevails. As the FedWatch tool shows, investors are currently pricing in 86.5% odds that the Fed will leave rates unchanged on September 20. Meanwhile, the bets of a hawkish and dovish outcome in November are almost evenly split. 50.7% of the market is on the side of a pause, while 43.7% are betting on a quarter-point hike and 5.6% on a half-point hike. The two-year Treasury, which is most sensitive to the outlook for monetary policy, tumbled to 4.9%. The benchmark 10-year Treasury yield hit an almost three-week low of 4.1%. The release of a GDP, non-farm payrolls and personal spending figures may shed more light on the U.S. economic outlook later this week. Today, the U.S. dollar experienced its biggest drop in a month and a half, and the greenback plummeted to 103.36 from yesterday's high of 104.36. In the Asian trade, the US currency was trying to recover, trading near 103.50. The US dollar index consolidated within a narrow daily range of 103.50 and 103.70. Despite the fact that the US dollar dropped sharply amid soaring yields, it seemed as a reaction to insignificant data. Meanwhile, the most important news is still to come. Notably, the International Monetary Fund may lend more cautiously. If so, the US currency is likely to see renewed demand against the backdrop of higher interest rates and inflation. In China, state-owned banks are reportedly preparing to cut rates on existing mortgage and deposit loans. This is the first time the Chinese authorities have taken such a step since the 2008 global financial crisis. Beijing is hoping to spur consumer demand in the real estate sector and support the ailing economy. Meanwhile, the People's Bank of China has set the official average level of the yuan much higher than expected since mid-month. In other words, the economy should be growing with a stronger currency, even though the authorities are acting to devalue it domestically. As a result, investors in the Asia-Pacific region are very cautious today. Rather than intentions and promises from the authorities, markets are still waiting for more concrete statistical reports. Reports on China's August Economic Activity Index as well as on business and consumer confidence will be released this week. They will provide an insight into the world's second-largest economy, which is the main trading partner in Asia. As a rule, a drop in shipments of Japanese cars and chips to China leads to a decline in Japan's exports. In April, the country recorded its longest period of a foreign trade deficit since 2015. And today, the fresh consumer confidence index was released in Japan, which disappointed investors in Asia. In August, this indicator unexpectedly slumped to 36.2%. In July, the index posted its highest level since December 2021, and the Japanese yen rebounded from its 10-month low of 147.30. due to the drop in the treasury yields. As a result, the dollar-yuan pair slid to 146.50 in Asian trading. However, the pair still remains in the intervention territory. Last year, the Japanese authorities intervened in the forex market when the pair was in this area. The pair was trading in the green in the range of 145.70 and 146.60 early Wednesday. The dollar-yuan pair may face another roadblock near today's monthly high of 147.37. If this level is pressed, bulls may try to test the area near the psychological level of 148. Meanwhile, the Australian dollar was heavily influenced by domestic reports today. According to the Australian Bureau of Statistics, the country's monthly consumer price index declined to 17-month low. Against this backdrop, the Reserve Bank of Australia is likely to keep its interest rate unchanged. Notably, the meeting of the Australian regulator will be held next week on September 5. The Aussie dollar pair began to fall this week. In the Asian session, it dropped from a two-week highs and traded in the range of 0.6450 and 0.6484. At the same time, the Aussie's gains were supported by risk sentiment in the United States, European and Asian stock markets. Meanwhile, the hurricane in the Gulf of Mexico makes investors worry about supply disruptions, driving up fuel prices, and this region accounts for about 15% of U.S. oil production and about 5% of natural gas production. Following energy prices, the Australian dollar edged higher to 0.6487 today. However, the Aussie began to slowly retreat from this high, falling below 0.6460, and the next resistance level for the currency is now at 0.6485. In addition, the level of 0.6445 offers support. The New Zealand dollar also lost its bullish momentum. After strengthening in the previous two sessions, the Kiwi reversed and decreased within the range of 0.5939 and 0.5976. The currency closed today trading session at 0.5950. And that's all for now. Leave your comments down below and don't miss our next video review. Remember that staying up to date is a key to success in trading. See you online soon.